Well, hello, everybody, and welcome. This is Cynthia Tumain with Interactive Brokers, and we're very pleased to have with us today Will Rhind with GraniteShares for today's presentation on breaking down commodities and gold in today's market. Now, Will is the founder and CEO of GraniteShares and is a 16-year veteran of the ETF industry with experience working at, building, and running ETF businesses. Prior to starting GraniteShares, he was the CEO of World Gold Trust Services, a sponsor of the $30 billion gold fund, GLD fund. So with that, I'm going to pass you the controls, Will. If you would go ahead and share your desktop, we'll get underway today. Thanks for joining us, Will, and welcome.
Thank you, Cynthia. Thank you so much for having me on this webinar today, and thank you everybody for listening and participating today. Good afternoon, wherever you are. It's just gone 12 o'clock here in New York, where I am. So with that, let's get started talking about commodities and gold in today's market. Some important disclosure information there. As Cynthia said, a little bit about me here, and then this is actually a picture of us ringing the bell at the New York Stock Exchange, actually just a few months ago for our gold ETF bar, as that's me in the middle, looking very happy, ringing the bell there, which is a really kind of good experience for anybody that has seen this before. So GraniteShares, we're a exchange-traded fund company, which means that we manufacture ETFs, and we have a beyond beta philosophy, which means that we're trying to build innovative investment strategies that really add value in the non-core part of the investor's portfolio. So that includes things like commodities and alternative income strategies. Overall, we're a team of with over 50 years plus of combined experience in the ETF market. And what we're trying to do is disrupt the kind of business as usual, status quo type environment that has crept into a lot of the investment industry. We're backed by some well-known investors, including Bain Capital and other well-known fintech-based investors. So what are we trying to do? We're trying to solve some key issues that have been prevalent in the ETF market really for a while. On the commodity side, investors that have previously been looking for commodity exposure have faced some challenges in the market. And some of those challenges could be high management fees, so costly vehicles, inefficiently structured vehicles, i.e. partnerships or ETNs, exchange-traded notes that carry credit risk. And some of these partnerships have been burdensome around tax time, i.e. they issue K1s that a lot of investors don't like around tax time. So we're trying to solve these problems for investors. And then on the income side, we know that investors are still looking for yield. This is a low interest rate environment and obviously rising now, but people are looking for something different than dividend paying stocks and or high yield bonds. And again, some of the things that we bought on the commodity side, we're trying to do on the alternative income, providing high income investment strategy, but without the K1 exposure. So that's something else that we're doing on the interest rate on the income side. So let's get into today's discussion. Let's talk about commodities. Let's talk about where we are and why people should consider an allocation to commodities. Well, the three main reasons really are as follows. So historically, commodities have been a hedge against inflationary pressures in the economy. They have been used as a portfolio diversifier, i.e. because commodities have a different return stream than equities and bonds. In other words, they move slightly differently. They're considered to be a diversifier against those other asset classes in a broad portfolio. And of course, obviously, like any asset class, there's the potential for price appreciation. Let's talk about what's happened, over the past sort of 20, 30 years or so in commodities, and give you a quick kind of whistle-stop tour through history. So what we're looking at here is a chart of the Bloomberg Commodity Index, and this is one of the major indices in the commodity world, and one that we benchmark to in one of our commodity funds. But this is going back, as you can see, to 1991, And it charts the progress of the commodity market up to that peak, which is circled first, which was just before the financial crisis, just before the market crashed in 2008. And then there was that sort of bounce back period after the collapse, where a lot of asset prices rose. There were fears around inflation, typically at that time driven by the immense quantitative easing programs. And of course, that sort of culminated in that 2011 peak, which also coincided with the peak in the gold market as well. And then really since that point, the market went on a multi-year decline, which really ended in about the beginning of 2016. So it was a pretty severe bear market for commodities, really in that period from 2011 to end of 2015. And then since the beginning of 2016, prices have been rising across the board for the first time in multiple years. So why are prices starting to rise, or why have prices been rising over the last couple of years? Well, really, here are some of the highlight things which we're going to talk about today. So first of all, improved demand and supply dynamics. So commodities are a supply-demand driven business, just like economics sort of 101 would dictate. You have more demand than supply. All things being equal, you have the potential for price appreciation. And we've had an environment over the last couple of years, especially coming out of that bear market, where we've just had improved demand dynamics. So increasing demand as the global economy has been growing, and therefore putting pressure on commodity markets, increasing prices. We've also had an environment of rising interest rates, which has led into a higher or increasing inflation expectations. That in turn is a slight improvement in volatility, followed by a weaker dollar. And then lastly, a fundamental concern over elevated asset price levels in other markets, most notably stocks and bonds. So this particular chart here, we talked through the commodity cycle. So commodities are a cyclical asset class. And with that, what we're trying to do here is show peak to trough, what typically happens within the commodity cycle. So if you start on the left of that chart and look at the phases 1 through 6, obviously going back to 1 again on the right-hand side, you start with normalization or the peak, going all the way through trough, and then back up to the peak of the next cycle. And I think at the bottom here, what we're trying to do is just overlay some years or some numbers on the bottom of that to give a little bit of context as to where we might be today. And I think if we think about 2016 being the trough of the last cycle, then where we are today in 2018, I think we're somewhere between this rebalancing phase and tightening phase, so 5 and 6 of the next cycle. So certainly far away from the peak at this stage, but somewhere probably in this rebalancing and tightening phase. And this particular chart here looks at the 4 stages of the business cycle and looks at the performance of US bonds, US equities, and commodities. Those are the different colored bars. And so the orange one being bonds, the kind of pinky salmon color being equities, and the red one being commodities. And if you look at the bottom of that chart, in red, you see the 4 stages of the business cycle. So you see trough, recovery, expansion, and then downturn. And then just kind of cast your eyes to the right-hand side of that and look at the last 2 phases, expansion and downturn. And you can see that in both expansion and downturn, you have commodities, i.e. the red bar, outperforming equities and bonds. And so typically when you start to see commodity prices rise and or indeed outperform stocks and bonds, it's typically what we call a late cycle indicator, which means that we may be nearing the end of the business cycle, and that has a sort of close correlation, obviously, with financial markets. So at this point in time, we have an environment where commodity prices are rising, and that typically, at least as far as history is concerned, has been a classic late cycle indicator. On the more fundamental side, clearly, going back to demand, we've had a situation where, since the financial crisis, what this chart is showing is the Purchasing Managers Index, and this indicates the economic health, particularly of the manufacturing sector. And of course, it's probably no surprise to any of you that as the economy has improved, since the financial crisis, so has the manufacturing sector, and so has the economy kind of more broadly. And at this particular point in time, we see very healthy PMI numbers, which is a strong indicator of global growth. And of course, strong PMIs typically have a high correlation with strong or higher commodity prices. Another thing which is interesting, which is depicted here in this particular chart, is you've got two particular lines here. And this is the 6-month rolling correlations. This is from 91 to 2018. So again, looking back at that sort of, roughly 30-year period. And the blue line is showing the correlation of commodities versus stocks, US stocks, against the orange line, the commodity correlations versus US bonds. And before the financial crisis, one of the points or the key attractions to investors about a diversification or an allocation to commodities were that commodities provided diversification. In other words, it performed differently to stocks and bonds, and that's why a lot of investors had commodities in the portfolio. And then after the financial crisis, what happened with commodities is the same as what happened with all sorts of other asset classes. Those correlations became much more correlated. So things that we thought weren't very correlated suddenly all correlated together, after the financial crisis. And slowly what we've seen, which has been a very healthy situation for the market, is over time, the last 10 years, those correlations have really returned to normal. And so we're sort of back now to where we were before, where we have commodity correlations against stocks and bonds returning to their historical norms, and that's a positive thing for the market. Similarly, another indicator that we look at, and obviously we're a part of this industry, part of this movement as well, as we look at the total number of assets invested, in this case in broad commodity ETFs. And because ETFs are publicly traded and all the information is completely transparent, we can see the amount of assets or capital invested into the ETF market. And again, you see the number of assets in the white sort of chart or the white line versus the Bloomberg Commodity Index in the orange line. And you can clearly see that since that trough, since that beginning of the commodity price recovery in 2016 that I was talking about, that investor capital has come back into the commodity sector really for the first time in many years. And so, it's too early to say yet whether this is part of a much broader trend, but you can clearly see that investors moving back into the market, again, thinking about moving, and typically this could be an indicator, again, of sort of sentiment or positive sentiment when it comes to commodities. Another chart or another thing that we look at is sort of the relative value, if you will, of commodities versus stocks, of other asset classes. In this particular chart, again, what we're showing is just a simple ratio of the commodity market divided by the S&P 500. And so if you look at this chart, again, going all the way back to 91, you see the bottom, which is circled, which we call the bottom of the commodity depression. And that was really at the height of the tech bubble. So at the bottom here, this is the commodity low versus stock high. And in this case, that's the tech bubble, moving obviously all the way up to that peak, which was a commodity price high against a stock market low after the financial crisis. And as you can see that if you go all the way over to the right and you follow that ratio down, that ratio today sits at around the same kind of level as it did back in the early 2000s or in 2000 at the height of the tech bubble. So again, just another sort of potential indicator that commodities really are at a low versus stocks, and to have potential for a rebound against stocks and other asset classes. Looking at that, in a different manner, this chart is really showing the same thing. It's just showing it in a slightly different way. And this particular one goes all the way back to the 70s. And as you can see here, there are just a few more peaks and troughs in this one, which I particularly like. The one we just looked at on the previous page was the tech bubble in 2000, and then where we are today. So those are highlighted in green at the bottom of the chart. And then in red, we have the previous commodity price sort of highs, which occurred in the financial crisis, obviously just before the financial crisis in 2008, the Gulf War in 1990, and then the oil crisis of the 70s. So again, just a similar sort of indicator, if you will, showing the ratio between stocks and commodities. And again, if history is any kind of guide, just showing that in terms of, or from a historical perspective, that commodities are certainly trading or seem to be cheap or inexpensive versus stocks, and at a similar level to past sort of lows, particularly the tech bubble, obviously, of 2000. What you're seeing, this chart is a little bit busy, so apologies for that. But I'm going to try and decipher it for you here. What we've got here is the VIX in the green. So the VIX is a measure of volatility in the market. You then have the ratio that we were talking about in terms of stocks versus commodities in the orange, going down from left to right. And then we have demand versus supply in the white line against a median sort of in the middle, which is that sort of separated by the white. So when the white line crosses the bar in the middle there, showing 1 on the right-hand scale, you have more demand than you have supply in the commodity market. And of course, below that, you have more supply than you have demand. So when you have more demand than supply, that's a bullish signal for commodity markets. And then in the pink line, you have the trade-weighted dollar index, or the strength of the dollar. So what we've had, obviously, in the last few years is to overlay that weak performance of commodities versus stocks. But we've also had an environment where the dollar has been weakening, strengthening over the last sort of little bit, and also the VIX, or volatility, has also been weakening over this time. So in an environment where inflation now is recovering from multi-decade lows, we've also started to see potentially the VIX, or volatility, recover from similar types of lows. And in an inflationary environment, or an environment where inflation is rising, commodities have the potential to outperform stocks and bonds. And we'll talk about that in the next slides here. So another thing which is kind of important to reference is the volatility market. And again, we sort of referenced this a little bit in the slide before, and this is the volatility index, or the VIX, most commonly it's known as. And this chart here goes all the way back to 2000, again, just showing how or what's happened really with volatility in the market, over the last kind of 20 years. And as you can see, that obviously in the market crash, the financial crisis in 2008, we had a huge volatility spike. Again, going to 2011, a big volatility spike, which again coincided with gold all-time high and commodity price recovery from the financial crisis. And that was primarily at the time, remember, fears that the US government could default on their debt, and that was in 2011. And then really since then, we've had this just declining volatility environment with the occasional spike, the one obviously earlier this year being a prime example. But apart from that, we've been living in this lower sort of volatility world. And again, if we start to see volatility picking up, I think that could be positive for commodities and other asset classes, not stocks and bonds. So switching gears a little bit, I think we've sort of set the scene as to what's going on in commodities and the current environment for commodity investing and some of the positives around the market and the changes certainly, over the last couple of years compared to the bull market before. But I want to spend some time going into gold at the moment and really talking about what's going on in that market because it's something that we focus on a lot here at GraniteShares, but also we get a lot of inquiries and questions from investors trying to really decipher or understand what's happening in gold, especially today. So similar to commodities, let's talk about gold in a more historical context. And again, think about what's happened. In this particular chart, I'm just focusing really on the last 3 years, so the period where gold prices really bottomed in 2016, along with commodities more broadly, and then what's happened since then. So as you can see, we've really had a period of fairly strong or robust gold price increase, and that really happened to probably the midpoint or so of last year. And then from then on, we've had a really weak environment for gold, and gold prices have been declining certainly throughout this year as well. So from kind of the beginning of this year, we've seen a decline in gold. Last year and the year before, a little bit increase, and that's really been primarily down to the dollar. So weakening dollar environment, good for gold, and typically one of the strongest relationships is inverse gold versus dollar. And so since really the beginning of this year, we've had a dollar environment that has been strengthening, and that hasn't been good for gold. Those are the two most important things, and we'll talk about some of the other factors as well. More recently, this is just looking at just the last sort of month, but this is sort of more symptomatic of a broader trend within gold. And this is really just this sort of band or narrow range that the gold price has been trading in, and that we haven't found a way out of these sort of narrow trading ranges where we trade a few dollars up, a few dollars down, but the gold market really looking for a catalyst to break out of these sort of narrow ranges. And this is just something typical of what we've been talking about, in the gold market the last sort of couple of years, whether that narrow range, moves up or moves down, but still this idea that we're really looking for something that kind of drives the price in one particular direction or the other. As we sort of talked about a few slides ago on the commodity side as it pertains to inflation, what this particular chart is looking at is inflation as measured by CPI here in the kind of gray line in the middle of that blue shaded area. And as you can see, that gray line moving up, and this is the strongest kind of inflationary backdrop we've had really for the last decade. And so in an environment where the CPI or inflation numbers are moving up, we also have an environment where the gold price, has moved up, accordingly, but against the backdrop where we've also had increasing or rising asset prices in stocks as well as other asset classes. And so, in this kind of historical context, and given that at some point, inflation is not good for stocks and or bonds, it again could be the case that the gold price is low versus stocks, given this sort of positive inflationary trend. And then this particular chart just shows the annual gold price correlations. Again, as per what I was saying earlier, you've got at the top here the strongest negative correlated asset to gold, which is unsurprisingly, this is the US dollar, the trade-weighted dollar index, and then moving down to the most positive correlated asset to gold, which is maybe unsurprising to some of you, is silver. So really at the moment, the strongest negative correlating asset to gold, and this particular chart here goes all the way back to 91. So this is a very, very strong and well-known relationship. Has been the dollar, in an environment where the dollar has been strengthening. It's a very challenging environment for gold. So obviously for the gold price to increase from here, we don't need the dollar to weaken or to go lower per se. We just need it to stop getting stronger. And the other thing, we can't talk about gold without talking about geopolitics and about potential, shocks around the world. And I think, again, we've been living in an environment over the last few years where we've had a lot of potential hotspots around the world, a lot of trouble in various different parts of the world, with concerns over, potentially major geopolitical events, but nothing has actually, transpired in a way that would move the gold price, and particularly, as everyone will know, sort of things like North Korea, which seemed to be a threat for a long time, now seem to have dissipated almost entirely, over the last sort of few months or so. So I think on the geopolitical side, that there's always, clearly we never know where the next sort of hotspot's going to come from, or the next sort of risk is going to come from. But at least over the last few years, we have been living in an environment where we just haven't had anything that really has caused the gold price to move in any kind of material way. So let's just summarize the potential catalysts here for a breakout in gold. And as I said, I think the number one thing for me at this particular point in time is a surprise or an increase in unexpected inflation. I think the market really ultimately, fears inflation, particularly unexpected inflation, more than almost anything else. And if we have an environment where we have a stronger inflationary number than expected, I think that would almost certainly be a positive for gold. And I think, the trade war situation going on at the moment is certainly adding more fuel to that inflationary fire. That at the end of the day, if these tariffs on China, if they ultimately result in higher consumer goods at Walmart, for example, that is going to affect consumers very directly in a way that has not happened really probably since the 70s. And so I think that will be a big change for people. And any kind of increase in inflation here, expect that to be most likely positive for gold and for commodities. Also, the volatility we talked about. We're living in this environment where volatility is trading again at lows or multi-decade lows, and any kind of increase in volatility has historically been good for commodities and or gold. Also on the geopolitical side, we just talked about anything that could result in some kind of shock and a risk-off type moment for the markets. Again, gold historically has been a beneficiary of those types of situations. And then lastly, obviously, the thing that is probably top of mind for a lot of investors is a market correction, both a correction in the bond market or the equity market. We're now going on 10 years in terms of a bull market since the financial crisis, and a lot of people trying to speculate as to how far into that we are, and then when, of course, a potential correction could happen. So expect some kind of market correction which causes increased volatility and sell-off in the market to be something that has a strong potential to benefit gold and or commodities. So I want to talk just for a couple of minutes, because we get a lot of questions on this in terms of how to get access to gold, how to buy, what are the differences between the different sort of methods. So principally, there are three main ways that people buy gold. So typically that's gold coins, which are classed as being physical gold that you can put into your hand. So gold coins, and to a lesser extent bars, but typically those types of options. Then you have ETFs, so exchange traded funds, and exchange traded funds that are backed typically by physical gold. And then mutual funds, which tend to be representing gold mining companies, i.e. stocks, not the actual underlying themselves. And I think certainly, from our perspective, what we've seen is, really a huge demand for ETFs, i.e. a way for people to own gold with an investment portfolio. And that's really what ETFs are all about. And a kind of growing preference for doing that versus the other two methods where on the mutual fund side, you may get exposure to mining companies, but you don't get exposure to the underlying gold price. And then on the coin side of things, while you can hold the coin in your hand, it's hard to use that as a true representation of the underlying price, given that for the retail market, there are quite significant premiums and discounts in the coin market that cause a lot of friction for buyers. So looking at the flows in terms of ETFs, again, talking about what's happened in the market and kind of where we may be. This particular chart here, again, similar to the one that we had on the commodity side, but shows at the top sort of segment in orange, this is the gold spot price, against gold ETF inflows in the white. And what's happened, over the last sort of few years is we've had a spot price environment where it's been a little bit down and up, but sort of fairly muted. But overlaid on top, we've actually had an increase in gold ETF holdings. So typically, again, from that sort of trough that we saw in late 2015, beginning of 2016, we've seen gold investors come back into the market and put more capital to work. And it could be an indicator that people are unsure about the equity market or looking to diversify portfolios. But the facts are that we've seen more money come into the space over the last few years. Contrast that on the bottom segment here, and this is an indication of the futures contracts traded, particularly on the CME, and this is typically speculative positions. And again, those speculative positions, on the other hand, have actually been pretty weak. So we've seen very strong short positions in the futures markets, which typically can indicate that more speculative-based traders, particularly hedge funds and things, are positioning bearishly on gold at this particular point in time. So if we think about this environment that we just showed, where we had more money coming into the ETF market, why is this happening versus the fundamental price movement where you have a declining gold price, but yet what this particular chart shows is the gold price falling, or the gold price performance, which is in the orange, against the shares of our gold ETF BAR. And so as the gold price has fallen, we've had more shares created and therefore more assets into BAR. And really, it's really kind of a couple of things happening here that I think at a broader level, what we're seeing is investors looking to reallocate money into gold, and that was sort of an extension of the slide that we just saw, that perhaps looking for an entry point at this level, this low level versus the equity market to maybe make a reallocation to gold. It's also a function of what new funds like BAR are doing to the gold landscape. And as the price of gold comes down, investors are looking at that opportunity to sell out of more expensive gold investments that they already have and go into a low-cost vehicle such as BAR. And in terms of some of the strategies around that, why investors have been putting money into the sector, I think, is probably a function of a few things. One, this idea that people are using tax loss harvesting strategies or other sorts of techniques to take advantage of an environment where you can sell a more expensive fund and gain the same exposure into a low-cost ETF like BAR. They're also dollar cost averaging back into the market and taking advantage of prices which are low versus other asset classes. And then thinking about the elevated levels in the stock and bond market and thinking about positioning their portfolios for diversification. and looking to put an allocation into a non or an uncorrelated asset class, something like gold. And I think gold has been a beneficiary of that as well. So in terms of those of you that listen to this and want to learn more, here is a little quick fact sheet on BAR, which is our physical gold ETF. So BAR is backed by physical gold, which is held in a maximum security vault in London. It's a no K1 vehicle, which means you don't have to worry about K1s over tax time. It's one of the lowest cost commodity ETFs in the US at 20 basis points or 0.20% per annum, and that's half or less than half of the cost of some other vehicles in the market. The exposure is backed by 400-ounce bars, typically, of fine metal of gold stored in London, and that's available, obviously, on Interactive Brokers and obviously in the marketplace under the ticker symbol BAR. Here's the performance data for the fund, but all we do is track the spot gold price. So the market goes up, the market goes down, and BAR tracks it. And then this is just a quick slide here showing the 5 funds that we offer. So we have the 2 broad-based commodity futures strategies at the top, ticker codes COMB and COMG. COMB is benchmarked to the Bloomberg Commodity Index, COMG benchmarked to the S&P GSCI Commodity Index. And those expense ratios really are among the lowest in the industry on the right-hand side. And we have Gold Trust. We also have a very similar ETF on Platinum, which is the GraniteShares Platinum Trust, a typical ticker code PLTM. And that, again, is giving exposure to underlying physical platinum, so tracking the platinum price up and down. And then our high-income ETF, which is HIPS, which stands for High Income Pass-Through Securities, under the ticker code HIPS. So this is a little page here in terms of how to get in contact with us, but we would love to hear from you, to hear your thoughts, to answer any questions that you have. We're always available to talk, very approachable company. So find us at the info email here or give us a call, but definitely always available to talk. So with that, I thank you so much for listening to today. I hope that's been interesting and informative for you. And with that, I think I'd like to pass it back to Cynthia, I think, to handle some questions if anybody has any.
Okay, and I would like to by the way, thank you so much, Will. Terrific information there. And I'd also like to remind all of you, if you have any questions for Will, now's the time to add those into the questions panel over on the right-hand side of your screen. And we'll be happy to take those questions. Will, there is a question in there about the technically significant 1200 level.
Yeah, let me see here. Okay, so I think this really goes back to one of the charts that I was showing about the kind of the banding and how it's really been difficult to break through these different bands. The upper side, obviously, most significantly, and 1200 obviously is around where we are today, and at some level, clearly we'd like to see a breakthrough of the 1200 level. But if I was doing this presentation a few months ago, we'd have been talking about, breaking through the 1300 level. And so I think, from a technical perspective, I understand why it's important in terms of, momentum in the underlying market and the key indicators that a lot of traders watch. But I think that why I sort of framed it from a more fundamental perspective is that what we're really looking for is a catalyst in order to move the market higher. So I think it's going to be tough to break through 1200 or any other sort of shorter term key technical indicators without something more fundamental happening in the market. And I think immediately that really has to do with the dollar, i.e. the dollar sort of rolling over a little bit and becoming softer, which is a positive for gold and commodities.
Okay. Well, I'm not seeing any additional questions come into that panel right now, but I do want to remind you that we have been recording today's session, and each of you will get a direct link to today's recorded playback. We'll also be including a PDF link or to the shares or to the slides that Will has shared with us today. So with that, we are going to conclude our session. I want to thank all of you for participating here today, and you can exit using the X in the upper right-hand corner of your screen. Have a great rest of your day, everyone. Thanks so much.